everyone for another episode as I continue on this saga about the cost segregation analysis as a tax strategy for those dentists who own their building and want to be educated on what this strategy is. In this episode, I'm going to talk about how to implement this correctly. And then I'm going to talk about how the numbers flow exactly, and we'll run through an example. Okay, so this is segment 6 for those of you watching on YouTube. For those of you not, on your phone and are watching on your phone, I will narrate this for you. And a little plug and favor for me, if you could subscribe to YouTube and to my podcast on your podcasting app, that would be fantastic. You'd be doing me the honors. Put a lot of time and prep into these. Yeah, I do use AI to help curate some of the content, but I always spend quite a bit of time taking that content, organizing it, and making sure it is distributed here to you on this podcast, and hopefully a way that is digestible to understand. Now, some of these concepts around accounting and cost segregation and passive activity and depreciation and bonus deductions, it can get a little bit complicated. But again, I really want you to listen once, twice, three times if needed to understand what these concepts are so that you can bring them up with your advisors and speak in an educated way about them. They're the specialists, but sometimes you got to be the one to spur on the conversation and to navigate it because nobody's going to care about your finances as much as you do. I will say here at Practice CFO, we care an awfully lot. It is why we come in. It is a huge part of our beating heart here, of our mission statement. It is because we care so much. That said, at the end of the day, this is your hard earned money. And so you got to take point on moving along the analytical and strategy discussions with your advisors. Okay, implementation, how to do this cost segregation right. Number one, so let's say you're about to buy your building, or you're about to buy the building and then start to build out if you're a startup, or you're relocating and you're taking it from a shell to an operating dental office. Step number one is form the LLC first. The LLC must be the purchaser of the deed. Form it before closing, not after. Now, if you do it after, you can transfer the building into the LLC, and you'll need to talk to the right type of attorney to do that. But I don't recommend buying the building first and then forming the LLC. So form the LLC, extremely easy. You literally could go on LegalZoom to do it and pay a modest amount. That said, look, you're a high income earner. If you're a practice owning doctor, ideally you're collecting north of a million. Ideally, if you're a client of practice CFO, we want you north of 1.5 and really cranking it. And if you are, you're in a high tax bracket. Look, you want to don't try to go cheap. You want to hire people who are going to advise you well. I would spend a lot more time doing due diligence on who your roster of advisors is, but I would and yeah, this may sound self-serving because I'm an advisor and I want our doctors to engage us. I believe strongly that the net effect is they're going to be better off by having good advisors with us or somebody else, but if they have a roster of really good advisors, I think dentists are going to be better off financially. Now, when it comes to the strategy of a cost segregation analysis, you want to make sure that you've got a good CPA and a good cost segregation company that's working together and a good attorney to make sure that your LLC is set up properly, the lease agreement is set up properly, you buy the building in the right order, and that the tax and accounting is done correctly on this. So one of the most important things wealthy people do, at least in really intelligent wealthy people do, is they surround themselves by very educated people. They get educated, the person gets educated enough to communicate across those different spheres and to organize an overall plan. So, step one, form the LLC first, not after. Step two, close on the building. The LLC obtains its own mortgage and you personally guarantee it. That is typically the case. Now, what does that mean that you personally guarantee it is if you default on the loan that you took out to buy the building, the bank can come after your personal assets. They can force you to sell your house. They can force you to sell your cars. They may force you to liquidate some stocks and bonds. They can't come after your IRAs and 401ks and other protected retirement assets like that, but they can come after a lot. And don't get scared. That's very, very normal for banks to require that. And that should not dissuade you from if the purchase price is reasonable to buy your building. Are you looking to buy or sell a dental practice? If you're a seller, how do you find a strong list of potential buyers? There's no MLS or Zillow for dental practice sales. In such a fragmented market, many dentists selling their practice feel discouraged. That's why I built PracticeOrbit.com. PracticeOrbit is modernizing how dental practices are bought and sold. It's a platform technology. Y'all know them: Zillow, Airbnb, Uber, and OpenTable, just to name a few. These technologies do two things. First, they help match buyers and sellers by centralizing the marketplace. Second, once the match between buyer and seller is made, these technologies help them navigate the sale to a successful close. Here are a few of the features inside of Practice Orbit. Users can determine a reasonable sale price for a practice in just minutes. All they need is the most recent business tax return. Practice owners can use the directory to find important service providers like practice brokers, attorneys, accountants, and bankers. Practice owners and their brokers can invite those service providers into the platform, so all parties are coordinating the sale together. Practice owners will have a beautiful digital listing of their practice, like a home on Redfin. And importantly, the listing will be anonymous, and personal information like your address, name, and pictures are only released after an NDA is signed and approved by you or your broker. Practice buyers can create saved searches to be auto-notified when new listings come on the platform that fit their desired specialty and location. And hey, dental practice brokers, you can list all your practices on the site for free. By doing so, you'll get access to Practice Orbit's large pool of buyers, all of whom have created profiles and saved searches to be auto-notified when new listings come for sale. You can use the platform to introduce your listings to a targeted set of buyers. Additionally, and optionally, you can use the platform tools such as a built-in NDA, a customizable LOI, and a workflow tool to navigate the sale from LOI to closing. In fact, you can manage all your listings on the system from listing the practice to NDA to LOI and finally to closing the deal. Create your free account today at www.practiceorbit.com. All right, so that's step number 2, close on the building. Step number 3, commission the cost segregation study. So that's where you will find a company, a qualified, usually an engineering firm. This is typically not your general CPA. For example, we here at Practice CFO don't do cost segregation analyses. It requires the engineering person to go and look at the plans of the building and to go through room by room and allocate out everything that you bought that you can touch into different categories. So it's not all in just that 39-year asset category, because that is the slowest accretion of tax benefit to your tax returns possible. You want to push those forward, accrete them earlier in your ownership life of that building. And that's what the cost seg can do it. And so you do need the right type of firm to do this correctly. Again, that's going to cost about $15,000 to $25,000, maybe $10,000 to $25,000. I care less about the cost in that sort of range. I care way more that it's somebody who's good and is going to go and really dissect that out well and push more of the building tangibles into the other shorter term asset buckets of 5, 7, and 15 years. Okay, so that's number 3, commission the cost segregation study. Number 4, so now you've got your LLC in place, you bought the building, you've engaged the cost segregation study, they've done the analysis now, and they've given you the report that says how you can break out the purchase price of the building between those different categories for depreciation purposes. And now step 4 is execute the lease agreement. And this should be a formal written arm's length lease agreement between the S-Corp that owns the dental practice and the LLC that owns the building. And you should get a market rent analysis from a commercial real estate broker. Again, pay a little bit of money to get something that you can file away and that will back your decision on what your rent is. That if the under an IRS audit, you can point and say, look, I paid this company, they're professionals, this is what they do, to do a cost seg analysis. And here's their report. And I followed what they counseled me to do. And here is a rent agreement from a real estate professional and a lawyer who put this together with an arm length lease between the S corp and the LLC to determine what that rent is and the terms of that lease agreement. You can point to that, and that way you are protecting your booty on this, and you need to do that. Again, don't try to do this one at home because you're not going to have these formal reports by formal professionals that you could point to in the event of an audit, and that can take something that should be a wonderful tax strategy to something that can haunt you for many years, because once on the IRS radar, always on the IRS radar, and they will typically not just audit the 1 year, they will then go and audit subsequent years or even years before that, depending on the statute of limitation. So number 4, execute the lease agreement with the help of professionals. Now, what should that lease rate be? Well, I'll talk about that here in a second. All right, and lastly, number 5, keep clean books. I cannot emphasize this. Have separate bank accounts for the LLC owning the building, the disregarded LLC, and a separate bank account for your S-Corp checking account. You should also have a credit card for your S corporation. I wouldn't necessarily say you need a credit card for the building LLC. There's typically not that many transactions because most of the transactions with maintenance and upkeep are actually paid by the tenant. They're paid by your S corporation, and those you absolutely can put on your credit card where allowed. Some doctors will still get a separate credit card for the building if there are certain things that they can buy or want to buy on credit card that should be inside of the building LLC. But again, the building LLC doesn't have many transactions once you buy it. You're paying your rent, and then every once in a while, if you have a big transaction like you have to buy a new HVAC or something big that the landlord will typically pay for, then you could have a credit card for that. But generally speaking, you may be even taking out a loan for some of those things. So don't complicate your life with extra checking accounts and credit card accounts. Only get what you need. And I typically recommend simply a checking account for your building LLC. Remember, every account, checking a credit card account you have, has to have in your accounting files, like QuickBooks, a separate general ledger account. And it needs to feed in the transactions and categorize those transactions and reconcile back to the bank and post to your financial statements. And guess what? CPAs typically will charge more when you have a lot more credit card accounts because it's a lot more work. And so keep it simple, keep it clean. Keep a separate Chinese wall between your building LLC and the practice. Okay, to reiterate those, number 1, form your LLC first. Number 2, close on the building, buy the building. Number 3, commission the cost seg analysis. Number 4, execute the lease agreement. And number 5, keep clean books. All right, let's look at some numbers here. How the numbers flow. For those of you watching on YouTube, on the left is your dental S corporation, and on the right is your real estate LLC. And I'm going to go through the very sandwiched version of the dental S corp. Number 1, your collections at 1.2 million collections. That's in my example here. Then all your clinical expenses except for your rent. So your labor, labs, supplies, marketing, and administration expenses equal 600,000. So now you're left with 600,000. Now you've decided that you're going to pay rent to the tune of 170,000 per year, which is 14,166, $14,167 per month. Now, is that a going rate? I don't know. That depends on where you are. If you're in beautiful La Jolla, San Diego, down the street here, about 10 miles away from me, your rent is going to be different than if you are in a small island in Alaska servicing a set of islands. Your rent's probably going to be next to nothing up there. And so what your market rate rent should be a function of market rates. And that's why you hire a real estate professional to help you with that. And so once you take that out, you're left with a net income to your S corporation of 430,000. That's 1.2 million in collections, less 600,000 in clinical expenses, less 170,000 in rent equals 430,000 net K1 to the dentist. Now you may pay yourself of that 430,000, 200,000 as a W2 and 230,000 is flow through K1 profit. Those two are just teeter-totters from each other and should be a function of tax planning, but that's an entirely different episode. So your net income in your corporation before paying you a W2 or your take-home sort of transfer K1, that's 430,000. Now, on the right side of the screen, your real estate LLC. Your rent is what? Well, it's the 170,000. Now, what do you get to deduct? You get to deduct mortgage, and maybe there's a few other costs in there. Maybe there's some CAM cost of area maintenance, or a few other costs. Typically, those are pushed down to the tenant, though, so there's really not a lot of costs. Your biggest cost is going to be the interest on the loan. Remember, the principal is not tax deductible, only the interest. So in this case, let's say you paid in the year $200,000 in loan payments. You may have got $80,000 of interest on that. That is tax deductible. So if that was your only expense, you're paying taxes on $90,000 of income. That's $170,000 of rent collected, less $80,000 of mortgage interest is $90,000. And that goes on your 1040 tax return. And it's taxed at ordinary tax rates, just like your W-2 and just like your K-1 from your corporation. So if you got a $170,000 tax deduction in your corporation, and but you had to recognize $90,000 of income in your real estate LLC, that is therefore 170 less 90,000. That is $80,000 of taxable income that you're still paying taxes on now. So how do you reduce that? What comes in then is depreciation. And if you do that cost segregation analysis, and let's say in year one, you're able to deduct $200,000 of depreciation because of that cost segregation analysis. And normally it might have been, I don't know, $40,000 or $50,000, but now you're at $200,000 because of the cost segregation analysis. You actually now ran a loss in that LLC of $110,000. That's $170,000 of rent collected income in your building LLC, less $80,000 of interest, less $200,000 of cost segregation deduction. That's a loss of $110,000. So now in your S corporation, you get a full deduction of the $170,000 of rent paid to your LLC. And because of the cost segregation, you've completely wiped out all of that $170,000 of income. And so now you're paying no taxes from the real estate LLC, zero. And in fact, you have this loss of $110,000. Now, if your spouse, if you listen to my prior episode, if your spouse is a real estate professional and works in real estate more than 750 hours, guess what? You could take that $110,000 loss in your real estate LLC and reduce the $430,000 of income from your dental practice. That is possibly the most beautiful scenario I can think of when it comes to this strategy of owning your building and doing a cost segregation analysis. It is absolutely beautiful. And by the way, and I'm going to go into this a little bit later, you could 1031 exchange your real estate, your building, into a bigger LLC property, and then you can do another cost segregation on that and then accelerate more deduction and do the same thing over and over and over. And honestly, this is what some of the wealthiest people in this country do. They layer and 1031 exchange into bigger and bigger and bigger and bigger properties, front loading all the depreciation, using it to offset older properties or other income, and then they'll borrow off the equity of the real estate, which is not tax deductible. So that all is how a lot of people completely get around the tax law. And I think in time, legislation is going to plug some of those loopholes, but that happens. Okay, so the net result is the $170,000 of rent lowers your K-1 from your S corporation, and the LLC pays no taxes. The rent is effectively tax-free income to you, and that is a beautiful thing. Now, I want to go into what should that rent be for a minute. This is a key point. The IRS knows that this can be manipulated. And the IRS will say that the rent should be a market value reasonable rent because we are incentivized to jack your rent up theoretically to the entire amount that would absorb 100% of your cost segregation depreciation in year one in your real estate LLC. So in the example that I just showed you that's still on the screen, that $110,000 loss that's in your real estate LLC, if you bumped up your rent by $110,000 to $280,000 up from $170,000, then you would absorb the full cost segregation depreciation of $200,000. And that would thereby essentially give you $280,000 of tax-free income into your LLC as rent from your S corporation, $200,000 of rental expense fully deducted in your S corporation, 100% tax deductible in the real estate LLC, but it becomes 100% tax-free because of the mortgage interest and then the $200,000 cost segregation depreciation. And you're absorbing 100% of that $200,000 rent. Now, the IRS may come in and say, whoa, $280,000 rent? What is that per month? 280 divided by 12. That's $23,000 a month.
Do you ever feel lost in your practice finances? And how about your personal finances? Ever wonder where your hard-earned money goes and why you're not seeing the financial progress you worked so hard for? If so, listen up. As a dental CPA and financial planner, I've created our company, Practice CFO, just for you. With almost 2 decades of experience, Practice CFO integrates great CPA services like accounting and tax with customized financial planning, both business and personal. Think of it this way. Our dental-focused CPA services give us the x-rays we need to clinically plan your global finances and be effective financial planners. It's a highly customized approach we call the CFO model. Historically, having a CFO or Chief Financial Officer was an advantage of large corporations only. But today, Practice CFO gives that same advantage to private dental practice owners. As a client of Practice CFO, you'll be assigned one of our dedicated CFO advisors. You'll receive insightful financial reports each month, have regular financial review meetings, reduce taxes, grow your wealth, and feel more in charge of your numbers. Because we believe that in the competitive landscape of dental practice ownership today, you have to be an effective business owner, not just a capable clinician. Reach out to learn more at www.practicecfo.com.
Doc, hey, you got a 1,800 square foot place in Podunk, I don't know, Nebraska. There's no way that the market rate on that thing is 22,000 whatever per month. You clearly are manipulating the system. We are going to disallow it. Not only are we going to disallow it, we're not going to give you any tax deduction as a form of penalty on that. So again, like your W-2 paid to yourself and your corporation, you need to be reasonable here. Now, real estate professionals are well aware of this, just like we CPAs are well aware of what your W-2 could be. And so you can stretch this. And so again, you want it using my favorite concept here, toe the line, not cross the line. So ask your real estate professional to give you as high of a market rate possible. What is the highest rate that you could justify at? Maybe look at higher end buildings down the street. I don't know. A cherry pick which market comps you want to use. I'm not a real estate professional, so I don't want to speak for them, but there are things that they can absolutely do to migrate up what is a reasonable rate rent to maximize the amount of rent you can pay from your dental S corporation to your real estate property. So that's the bottom line there. Talk to a real estate professional, tell them you're about the strategy here and that you want to optimize this. Maybe even get two real estate professionals who will come in and take the higher of the two and then hire a dental attorney or a real estate attorney to memorialize that rate in a lease agreement between your dental S corporation and your real estate LLC. Okay, options when you retire. I'm moving on now to segment 8, entirely different section. All right, you bought your building many years ago. You're now ready to retire. You're in your mid 50s to 70, early 70s, and you're ready to hang up the hat. You've done your financial plan. You've got enough capital such that you could live off between that and Social Security and any other sources of income that you don't need to work anymore. You've done the analysis of what your take home will be upon selling your practice. And after taxes and debt and selling costs, you are financially comfortable that you can now pivot into retirement. And by the way, Practice Orbit is free to log in. Use the price assessment on the bottom left of your My Dashboard. Get your last year's business tax return. Take 30 seconds, fill it out, and you'll have a good idea of what you could sell your practice for and what you'll take home after taxes and selling expenses and debt. It's a beautiful little analysis calculator and will allow you to take that to your financial planner to make sure you are, in fact, ready financially to pivot into retirement. Okay, so you're there, you're about to retire. What do you do with the building? I got three options here. Option one, you keep the building and you use it as a passive rental income. And hey, dentists are very reliable tenants. That is a absolutely a beautiful thing to do. The only reason to not do that is if you need to tap in to the equity of your building, you're not going to be able to do that without selling. Now, you could do possibly a line of credit to tap into the income on your building for sure. Sometimes people need that cash because maybe they want to buy a second retirement home in, I don't know, Hawaii or Big Bear or Mammoth or some other place. and they want cash to do that, so they can sell it to have cash as a down payment on the new one. And potentially, if they're going to rent out the new one and it's a commercial asset, or better said, it's a rental asset, they could do it 1031, which I'm going to talk about it here in a sec. So option one, keep the building, use it as passive rental income from the new tenant dentist. Number three, or it doesn't have to be a dentist. You could sell it to a retail vendor and they resuit the property to a different type of property. Option number two is sell a building, pay the capital gains tax, and invest the remainder. And so if you have a $2 million building, you may sell it, you may walk away with, after all is said and done, I don't know, $1 million. And then you can go throw that in the stock markets, in stocks paying good dividends. There's a lot of really good value companies out there, less sexy companies, been around a long time, paying really good dividends, 4, 5, 6% rate dividends. And they're passive. The thing about owning your building is it's not entirely passive. I mean, the IRS tax code calls it passive, but it's not entirely passive because you got things that go wrong. You have to renegotiate leases. You got to fix things. You got TIs. You got complaints. You got vacancies that you have to fill. You might have to hire a practice, a management company. Not entirely passive. And depending on your investment personality, a lot of people just detest being pulled into that kind of thing. Oh, the AC is not working. Great. I got to go fix it. I got to call somebody. I got to have my vendor list, yada, yada, my independent contractors. And if you're into that kind of thing and you really like that, great. If you're not and you want to spend your time traveling or being with kids and spend 100% of your time doing those other things, then honestly, owning real estate is not the best type of asset for you to own. Okay, so option two is to sell a building, pay the capital tax, and invest the difference. Option number three is you sell a building, but you exchange it into a new property through what's called a 1031 exchange. If you are at all involved in real estate investing, you know exactly what this is. This like real estate investing 101 for dummies. And the 1031 exchange is you sell your building, you take the proceeds, and in a given time period, you use those proceeds 100% down into a new property. Then you don't have to pay taxes. Instead, you carry over what's called your tax basis from the old property into the new property. And the tax basis is simply what you bought it for less what you depreciated it over time, plus any capital improvements. It's like a piggy bank. And so let's say you bought a building for 2 million, and over a 15-year period, you depreciated it down to 700,000. Well, when you buy the new property, your basis in that new property, let's say you buy a $4 million property, your basis is $700,000. And so then you immediately in turn sold that $4 million property, you're going to pay taxes on $3.3 million because you carried over your tax basis. Now, there's more calculations there depending on the nuances of that particular transaction. But the key thing about a 1031 exchange is you're simply punting the tax bill down the road. If you didn't get what I just said, just know you're punting the tax bill down the road. And if you punt it down the road far enough and you pass away still owning that building, then there's what's called a step up in basis where your beneficiaries, most likely your kids, get that building and what they essentially get it for from a tax standpoint is the market value at the date of your death. And that's called a step up in basis. And therefore, it 100% escapes paying capital gains taxes on the sale. This is what extremely wealthy people do who are into real estate is they keep 1031 exchanging into bigger and bigger properties, deferring the taxes till they die. And again, they'll pull out a loan on that to live on sometimes if they want cash. And then when they die, it gets stepped up and their beneficiaries pay no taxes. And if their total estate is less than that $12 million plus or minus here in 2026, then they don't even pay taxes on the value of that property in their estate. And if they're married, it's twice that. Now, if you're uber rich, worth 50 million, 100 million plus, then yeah, you're going to pay death taxes, estate taxes on that, on your estate when you pass away. Okay, so options when you retire: number one, keep the building, passive rental income. Option two, sell the building, pay the capital gains tax, and invest the remainder somewhere. And option number three, you do a 1031 exchange to a new property. And it doesn't have to happen right when you sell, but just sometime in your retirement, you have all three of those options. Okay. Yep. And if you are watching my screen, like it says there on the bottom, you could borrow against that property for non taxable income. All right, everyone, let's go ahead and end off with that one for this episode. On the next episode, I'm going to do 5 key takeaways with the cost segregation series here, things to remember. And then I will also talk a little bit about hiring a specialist company, and we will end the series there. So thanks for joining. Until next time.